What's going on, guys? In this video, I'm going to share with you how I raised over $600,000 online through equity crowdfunding on Wefunder. If you're not familiar with equity crowdfunding, it's a relatively new way for private companies to receive investments from anyone. And when I say anyone, I mean literally anyone can invest as little as $50 into select private companies. In this video, I'm going to share with you specifically how My SwimPro raised over $500,000 across 2 different equity crowdfunding campaigns. If you're interested in making investments in equity crowdfunding companies, I'm going to share with you some FAQs to help you lead along the way. And if you're interested in raising money for your business via equity crowdfunding, I'll share with you everything we did at My SwimPro, the good, the bad, and the ugly, so you can make the most informed decisions and raise the most money possible. In this series specifically, I help entrepreneurs take their business to the next level. And if you're thinking about starting a business and you have that idea in your head, I'll share with you the right entrepreneurial mindset and the right tips and tricks that you need to take those first steps. If any of that sounds interesting, make sure you guys subscribe to the channel, like this video, and let's get right into it. So before we begin, I want to share a little bit of background about My SwimPro on the finance side so you have some context before we get into it. The company was started in 2015, and in that year, we didn't raise any outside capital. We're what you would call bootstrapped. It was all sweat equity. Myself and my co-founders, we were putting in the work, not making any money, not raising any money, just grinding it out bootstrapped. In 2016, we received our first investment. It was $50,000 through an accelerator at the University of Michigan, the Desai Accelerator. Amazing opportunity, awesome program. It was our first investment in, and we raised this money via a SAFE. Simple agreement for future equity. Now, this is important because we use this same financial instrument when we raised equity crowdfunding in 2017 and 2019. We're going to talk about the FAQs, but I want to jump into the SAFE because it helps give some context before we talk about equity crowdfunding. So I mentioned a SAFE is simply an acronym for Simple Agreement for Future Equity. This is not exactly what you'd see on Shark Tank, where someone's pitching an investor for 10% of the company for X amount. A SAFE works a little bit different. Actually, it works a lot different because it will convert into equity at a later date. More specifically, in exchange for money, the investor has the right to purchase stock at the future financing round of the company. Meaning, you basically get not a stock certificate, but you get a document saying that you will own some part of the company at a future price round of financing given the terms of the SAFE agreement. Now, it is a simple agreement for future equity, so it is actually pretty simple compared to different types of financing structures. You will convert into equity at the next price round, meaning when you raise via a SAFE, there may be a valuation cap on the company or there might not be any valuation at all. And this is really important because to keep it simple and to keep it cheap and to keep it fast, you don't want to get too complicated in the finances of the company when it's so early stage. Because when you're doing equity crowdfunding or you're investing as an angel investor, you don't really know a lot about the company. You're betting on the team, the market, the potential traction that they've maybe been able to demonstrate over a relatively short period of time. So because of that, you don't really have a lot of financial information to base a valuation on. So for example, in the 2016 round, if you will, that $50,000 was actually on an uncapped SAFE, meaning there is no valuation cap on that money. So that $50,000 would convert at whatever valuation the next price round of financing is. I don't want to get too into the weeds, but it's really important for the SAFE to consider that you do not have to set a valuation based on very little data. So rather than on Shark Tank, you see people come in and they say, my company is worth $2 million, $5 million, $500,000. None of that really works, especially in technology, early stage, if you're doing real angel investing and in equity crowdfunding. That's why we have a SAFE cap. So in 2017, we did raise equity crowdfunding on Wefunder. We raised $130,000, $530. That was all done on a SAFE. We'll talk about it more specifically, the terms. There was a $5 million valuation cap. Then in 2018, we didn't raise any money. We became profitable, continued to grow the business. Then in 2019, we decided to accelerate some things, put some gasoline on the company. Not literal gasoline, but gasoline on the fire to make it grow faster. And we raised just under $500,000, $465,746. And then between those 2 rounds, we raised close to an additional $100,000 through different financings. My SwimPro in total has raised just under $1 million between investments and grants. Grants are great because it's free money. And then in 2020, we're currently in the middle of a global pandemic, so we weren't really planning on raising money anyway, but we're definitely not going to be raising money in the near future. And in the future, potentially next year or the year after, depending on how things go, we'll raise anywhere from $1 to $5 million, I can see, in a price round, in which case these 2 rounds and the additional investment, $50,000 and some other investments, will convert into actual equity. So that's a little bit of a background on My SwimPro to give context to what we did in 2017 and 2019. Before we get into that, I want to talk about the FAQs. What are the most frequently asked questions about equity crowdfunding? I get these questions maybe once every other day, at least once a week. The first question is, what is equity crowdfunding? So if you made it this far in the video, awesome, thank you. Make sure you give the video a like. Equity crowdfunding is different from traditional crowdfunding. So crowdfunding, you've probably heard of it, is a method of raising capital from your friends, family, customers, maybe they're existing customers, potentially new customers. You might be pre-selling a widget. It could be a donation, Kickstarter, GoFundMe. A lot of these platforms exist on the web and they become popular over the last 10 or 15 years or so. Equity crowdfunding is not like that. Some elements are the same. The concept that's the same is the fact that you're publicly asking for money and literally anyone can anyone can invest in equity crowdfunding versus donate in regular crowdfunding. So with equity crowdfunding, it is legal and you are essentially publicly asking people for money to invest into your company rather than donate. You can tie in some other cool perks around that. We'll talk about that. But equity crowdfunding is legal. And the reason why it's not legal in a traditional sense is because traditionally, before the Jobs Act came out just a few years ago, 2016 territory, at that time, you had to be what's considered a professional investor to make investments in these private companies. And so you couldn't, as a founder, as a CEO, entrepreneur, you couldn't publicly ask for money in any kind of forum because you can't do that. It's illegal. And so after the Jobs Act happened, now you can publicly ask for money in a public forum. You can set the terms and you can actually have your friends who are non-professional investors invest in your business online through a platform like Wefunder or any of the other platforms that are legally allowed to do it. So yes, you file a Form C with the SEC through a great platform partner like Wefunder, who we raised on twice. And through this format, non-professional investors can invest. So you're thinking to yourself, what is a non-professional investor? A non-professional investor is someone who makes under $200,000 per year. Basically, they're not a professional investor. And they have less than $1 million liquid in assets. So to be an investor, professional investor in the eyes of the government, you have to have over $200K salary, over $1 million liquid in assets. That does not include your primary residence. So you've got to have some bank. And traditionally, investments like private companies into My SwimPro was reserved for the wealthiest of wealthiest. And this is where you see those analogies of the wealthy get even wealthier. And the general population didn't have access to companies like through equity crowdfunding. So it's an amazing opportunity to be able to do this. I want to make sure I'm not missing anything else. Yes, we call this an open public offering. So similar to an IPO where anyone can invest in the company, in an equity crowdfunding campaign, it's called an open public offering, and it's only for a segmented period of time. In the traditional stock market, when you have an IPO, the company becomes available for public sale of shares, and you can buy stock one day, and then the next day you can sell it. You can sell it, buy and sell within the same day. In equity crowdfunding, you can't do that. You put your money in, and you don't get your money out. And you can only put your money in this open public offering window that might be anywhere from 2 weeks to 4 weeks to 10 months. Traditionally, it's around a month, and we'll talk about that at My SwimPro, how we did it in those two different rounds. And yes, this is legal. Wefunder, I've mentioned it a couple of times, is like the Kickstarter for investing. It's one of the largest platforms that has the highest volume, and the companies that have raised on this platform, which is why we picked it, have now gone on to raise over $1 billion in future follow-on financing. So it's a really awesome website. They're a great community, and they're one of the few that's legally allowed to do this. So you can't just open up a website on your own. You have to be approved by the SEC to be able to do this legally. And these platforms pretty much do everything for you. So you don't really file any paperwork. The legal setup is very, very minimal. So check it out, wefunder.com. And actually, if you go to the link, if you're thinking about raising money, if you go to the link in the description, if you use my promo, not a promo, but if you use my URL, you can actually get 10% off of the platform fee, which they take a certain percentage away from how much you raise. So if you raise $500,000 on the platform, and the platform takes 10% of that raise, that's how they make money, then you owe them $50,000. You might be thinking to yourself, wow, that sounds a lot of money. That's how, Wefunder and these other platforms make money. I believe Wefunder is less than 10%. But if you use my code, you'll get 10% off of whatever the discount that you're going to get. And so these platforms take, anywhere from 10,000, 50,000, maybe 100,000, depending on how much money you raise. You might be thinking to yourself, wow, that's a lot. They only built a website. Yeah, but they did all the legal stuff for you, and they're officially allowed to be able to host this. And if you think about the commission that a company like Apple or Google takes in the App Store, they take up to 30%. So most of these equity crowdfunding platforms are anywhere from 7 to 10%. So if you use my code, you can get 10% off of that, which could save you thousands or tens of thousands of dollars, and there's zero upfront fee. So check it out, linked in the description if you're interested in setting up an equity crowdfunding campaign to raise money for your business. Now, another really common question that happens is, what happens to the money after you invest? So you just made a $500 investment, $1,000, $10,000 investment. Does it go straight to the founder's pocket? A lot of people think that money's flying, they just raised a ton of cash. Doesn't exactly work that way. In equity crowdfunding, normally the money will go to an escrow account, and when the campaign closes, in a relatively short period of time, you'll receive the investment. Maybe it's 2 weeks, 3 weeks, 4 weeks, and it'll all come in pretty much one big chunk, or at least a few big chunks, because people have to submit the funds and everything like that. So as an investor, you invest your capital, and eventually it'll make its way into the company through after an escrow account. It really does go straight to the company, so it's not really sitting in any other market. You might be thinking, oh, maybe the money's collecting interest somewhere else. It doesn't really work like that. Some websites, platforms, not Wefunder, will set up an SVP, which is basically a way to group all the investors together. So if there's 500 investors, you'll basically get one investor through an SVP, and that way your cap table is potentially kept a little bit more clean, where you have only one investor through equity crowdfunding as opposed to 300, 500, 1,000 different investors on your cap table. Another question that's really common is, when will I see a return on my investment? So you might be thinking to yourself, if you can't take your money out of the investment, well, how do you make your money back? If you go and invest in a public company like Amazon, the next day you can pull your money out. Maybe it gained value, maybe it dropped in value. The point is, you can pull your money out. That's not how it works in early stage companies, not for the most part. So there's only 4 ways you can actually get a return on your money in equity crowdfunding. And this is something that's super important to understand if you're the founder, if you're the investor, whether you're raising money or investing in any early stage company that is not in the public market. So there's only 4 ways. The first way is you can go public and take the company to a public market. The chances of this happening are extremely low, but it can definitely happen. These are the companies like your Facebooks, your Snapchats, your Amazons and Netflix of the world. These are publicly traded companies. So if you invest, take for example, Peter Thiel's first investment into Facebook, he invested $500,000 at a $5 million valuation. He owned 10% of the company. Facebook, you can look it up now, is worth maybe $500 billion or more at the time of this video. So you can imagine what happened to his initial $500,000. If you're owning any percent of a company that large, it's pretty massive, and you can sell your shares, and that's how you can get liquidity. Another way to get liquidity, which is more common in early stage, especially technology companies, is to be acquired by a much larger company. For example, Facebook purchased WhatsApp and Instagram, and Facebook purchased Instagram for $1 billion. The early investors in Instagram were investing at a valuation much lower than $1 billion. Maybe an investor invested at a $100 million valuation 2 years before the company was purchased for $1 billion. So the investors, theoretically, on paper, 10x their money in a matter of 2 years. So the potential to make a lot of money is huge, assuming the company can grow. The potential to go to zero and make no money is also, if not bigger, opportunity for you. So you got to weigh that as a balance. So those are the 2 most common ways that a company, you can get your money back as an investment. The third way is kind of a cross of the last one, a private equity liquidity event. This is where a private equity firm buys companies and sells companies, and they want to acquire either part or the entire part of the company, and the investor initially who invested in the beginning gets liquidity at that point. Another version of this is a future investor in a future round. So let's say it's that price round financing. They want to clean up the cap table and they want to buy out all of the smaller investors. At that point, you get the multiple, whatever it is. It could be actually worth less than your initial investment if the company dropped in value from whatever the valuation was at the time of financing. And that's another way to get liquidity. And the fourth way, which is the least common way, is through dividends or paying back the money. This is the most uncommon way, but it's definitely a possibility. You raise $500,000. In 5 years, the company is really successful. That $500,000 turned this thing into a tens of millions, hundreds of millions revenue company, and now they have the ability to pay back at some multiple that makes sense through an internal financing, and the company can basically buy out all of the investors, or they can pay dividends. That is probably the most uncommon, but it's definitely a possibility that we don't want to forget about. And the final question, which is the most important if you're thinking about investing in any kind of early stage company, whether it's equity crowdfunding or not, is can I withdraw my investment? Question mark. The answer is no. You cannot withdraw your investment. The only opportunity you have to take your investment out is before the close of the online campaign. Before the open public offering closes, you can pull your investment out up to 48 hours, I believe, before that closes. If the investment round closes and you're invested, there is absolutely no way that you can get the money unless you knock on the founder's doors and you ask for a personal check, which is probably not going to happen, and you shouldn't do that. So what do we learn from this? You should not invest in the company unless you can 100% lose the money and never see it ever again, because that is a potential of investing so early stage. On the flip side, there's the opportunity to make a lot of money because you're investing at the first round or one of the first rounds of a high growth potential company. This is what's considered an alternative investment. Alternative investments should only be a small part of your portfolio. That's talking about investment strategy. I myself am personally an investor in a number of different companies through equity crowdfunding, and this is really cash that I can afford to lose. I don't want to lose it, and I don't expect to lose it in all of these investments, but you have to know that that is certainly a possibility. So do not invest your life savings in a company because you like the founder or you think it's a cool idea. Now, let's talk about the My SwimPro 2017 fundraise, and if you're thinking about investing in a company, it's really important to hear it from the founder's perspective as to why you would want to invest at different stages and the thought process of the founder if you're thinking about raising for your business, how I thought about this. So here's a great case example. In 2017, the traction our company had at that point, we were just named App of the Year. We were approaching a new market. People were familiar with fitness apps. They knew that there wasn't really a good one in swimming. My SwimPro had positioned itself as the front runner, and we had relatively favorable terms. The terms are a safe, simple agreement for future equity, and we set a $5 million valuation cap, meaning in the future, if the company was worth $100 million, all of these investors would be protected at that $5 million valuation cap, and we set a $100 investment minimum. The numbers, we ended up raising over $130,000 from 137 different investors. Average investment size, I believe, was around 800 or so. And the perks that we offer, this is a fun thing, you can not only invest in the company, but if you invest $250 in 2017, this is our perks, you get a My SwimPro t-shirt. If you invest $500, you get to add a stroke analysis on top of that. And if you invest $1,000, you get the My SwimPro software application premium membership for life. Pretty good deal. The membership at the time, I believe, $120. You get it for life, included in your investment. Obviously, you shouldn't be investing for these perks, but they're kind of nice nudges to push people along. And the main selling point in 2017 for this equity crowdfunding campaign was the fact that we were App of the Year. You literally have the opportunity to invest at a $5 million valuation cap in Apple's App of the Year. Pretty amazing opportunity. To be honest, I'm not sure why we didn't raise more money, but we were starting out, we didn't really have the revenue traction that a lot of early stage companies raising actually do have. So because we were so early stage, we did have App of the Year going for us. We ended up keeping the campaign open for, I believe, 4 months over the summer, and we really pushed the deadline on that, and we got just over $130,000. Then in 2018, I mentioned we didn't raise any money. 2019, we were considering raising again, and we realized, you know what, we figured out the formula in 2017. We have a bigger audience. If we just do the same thing, we're probably going to raise maybe 2 or 3 times more money because we have 2 or 3 times more audience. So if we hustle just like we did in 2017, we could probably raise more money. And we ended up doing that. So the traction in 2019 was a lot different. We had built out a bigger company, meaning we had more team members, we had more revenue, more traction. We had over 5,000 recurring paying customers at this point. We had developed international partnerships, pretty awesome. And the terms here was a safe, simple agreement for future equity at a $10 million valuation cap, and we set a $500 minimum to invest. We also set an early bird discount. That means if you invested in the first $200,000 raised of the round, you would get a 20% discount on the $10 million valuation cap. I think I'm gonna do another video just on equity crowdfunding via safes, just to explain the different possibilities of safes. If that's interesting to you guys, let me know in the comments if you'd like to see that. I'll definitely do that video and link it here in the future. But we did do an early bird discount to motivate people to invest in the beginning. So if you're one of the first investors, meaning before we hit $200,000 in total investment, then you will get a 20% discount. We ended up raising almost $500,000, $465,000 from 205 investors. I believe 58 or so were in that early bird special. So 58 came in within the first 200,000, and they got an awesome discount. 20% is a pretty good deal. The perks, we upped the perks significantly this time around. For $1,000, you get a quarter zip, like the one I'm wearing right now. For $5,000, you get the lifetime My SwimPro subscription. If you notice, this is 5 times the investment perk of the 2017 campaign. And the reason why we did that, because in 2017, we had people investing at the $1,000 level just to get the membership for life. So they weren't even looking at it as an investment. They loved our product so much that they were willing to pay $1,000 and just buy up front the whole membership for life. And so we saw that opportunity to up the ante and go for $5,000. So we 5 times that value. And then at $25,000, the perk is pro rata investment rights, which basically means the investor has the opportunity to continue to participate in rounds of financing at the terms of the lead investor. Anyone else who's investing under $25,000 doesn't really have any say, no votes or anything. The votes are all proxied to the CEO, so don't think if you have 400 investors in the company that now all of a sudden you have 400 people trying to tell you what to do. It doesn't really work like that. We also had the same perk at the 2017 raise. So we had the $25,000 minimum, which is pretty common to have pro rata investment rights. In total, between the 2017 2019 rounds, we have over 300 investors that span over 36 different countries. There's a number of different benefits of having such an international investor base, and no, it doesn't really take a lot of work to manage that kind of an investor base. I'm very good at communicating on a monthly basis with our investors. They all know what we're up to. If you're interested in being on that investor update list, let me know in the comments. Happy to add you. Why would you invest in My SwimPro? And I think this is really fundamental to understanding the psychology of the entrepreneur, of why you would want to do equity crowdfunding, and the investor, why you would want to invest in such a company. So why would we want to invest in My SwimPro? We had 4 main selling points. Number 1 was to make an impact. At My SwimPro, we are fundamentally helping people improve their performance and health. We want to improve people mental health, physical health. And it's a great cause. We want to help people live happier and healthier lives. So that's something that's pretty easy to kind of get behind. And if you invest in us and you invest in the team and the product, we will help more people around the world lead happier and healthier lives. Sounds pretty good. So that's reason number 1. Reason number 2 why you should invest is to shape the future of the industry. We have a front-running position. You can say you invested in Apple's App of the Year. We are defining the category and making innovation and technology change and adaptations that have never been seen before. So if you want to be a part of that in swimming, in triathlon, in health and fitness, you should be invested in that kind of a cause. The third point is that this is a rare investment opportunity. I mentioned it a few times, but how cool is that to be invested in the App of the Year? If you're looking for alternative investments, you want to diversify your portfolio, you can invest in the App of the Year. And ideally, our company grows and is very big and successful, and your investment gives you a financial return. The goal here is to make our investors money. It won't happen in the short term, but we know that if we continue to grind and we can build our company, build it to be more successful, drive more revenue, exposure, partnerships, that at some point there will be an opportunity for one of these 4 liquidity events, and all of our investors will get some kind of a return. Now, let's talk about the good, bad, and ugly of equity crowdfunding. Having gone through this 2 times, I have a lot of experience. I've consulted with a number of different founders, over a dozen different companies specifically, on how they can improve their equity crowdfunding. I've personally invested in different equity crowdfunding campaigns, including My SwimPro. I am an investor in both of these rounds, so I have a pretty good idea of the good, bad, and ugly. So from my perspective, the best part about this is that it's all digital fundraising, and you can kill 2 birds with 1 stone, meaning you can market your company, you can market, I didn't mention in 2019 we were pushing My TriPro, a new application for us, so we were really marketing something at the same time as fundraising. So you can kill with your time 2 birds with 1 stone, and you can do it all in a digital fashion. So you can send an email to your audience and you can say, hey, we're open for investment. Here's some how-tos, FAQs, and this is how you can invest and own a piece of the company. And you don't have to get out of your chair. You don't have to pick up the phone. Now you will end up doing videos, phones, calls, all that good stuff. However, to be able to do that from the comfort of your home and not have to actually go anywhere is pretty amazing to raise funds. And I didn't mention, but in 2019, we raised almost $500,000 in less than 3 weeks. So we had the campaign open in 2017 for 4 months, and in less than a month, we raised 3 times as much capital because we had figured out what we need to do. We knew how to leverage our digital channels. The website that we had is amazing. I'll link it. It's wefunder.com/MySwimPro. You can see and get an idea of what our campaign looked like. And the bad is that it's really difficult to create these perks. If you don't have a physical product, like we're an app, so I can give you a quarter zip, cool hoodie or something like that, or a t-shirt, but it's not really gonna push people over the edge. So that's one area I think we were not as strong at. You also have to educate people a lot. You have to educate people about equity crowdfunding. One of the reasons why I'm making this video. You have to educate people about the financial terms and how they work and all the different scenarios. What is a safe? How do I get my money back? What are the risks involved? What are the things that I need to know? So you have to do a lot of education to a lot more people, and you have to really spell things out. Interestingly enough, you get pulled on both directions. So a professional investor may not be familiar with a safe or equity crowdfunding, and a layman person, anyone on the street, doesn't know anything about either of those. So you're catering to so many diverse people, and that can be a time suck, and especially if you're not organized or the best at communicating something like that, it can be a huge time suck and really drag you down. Another problem with all of this is that people can invest and then pull their money out before the close of the campaign. We actually had this, we had someone invest $25,000. We were so pumped, we were high-fiving each other, we were all excited, and then sure enough, like a week later, this individual pulled their money out before the campaign closed. So that really sucks, quite frankly. And then another ugly piece of this is that people are cheaper than you think. This could be people that you know personally, your customers. It's just as difficult to raise $1,000 as it is to raise $100. You might think, well, $100 is pretty easy. I would argue that it's actually easier to raise slightly bigger chunks of cash than a smaller amount of money. Now, there's a balance. It depends on your market, depends on who you are, who you know, all that good stuff. But that's definitely one of the things that makes this really challenging. So here are my tips, if you haven't pulled any already from everything that I just said. If you are going to raise equity crowdfunding, some things that I want you to consider. Number one is you should have pre-committed investors right off the get-go. That is something we did differently in 2019 compared to 2017, meaning we actually had our website pre-allow investments, but they didn't show the total for a week before we actually opened the campaign. I think this definitely helped contribute the fact that we only had it open for 2.5 weeks. Another thing that you should do is you should set a high minimum. If you notice, in 2019, we set a $500 minimum. In 2017, we set a $100 minimum. I will tell you, the math works out. These minimal investors were 5 times as valuable as the investors who only invested $100. Again, it makes it easier to communicate with these individuals who are more serious, and the amount that you invest ends up being significantly more. I mean, look at, we raised from $1,000 to get our membership for free, for life, to $5,000. So we 5 times those values. We didn't 5 times the amount that we raised. Of course, there were other factors, but it definitely contributed to us raising close to $500,000. So set a high minimum. I definitely recommend setting an early bird perk. Think about the perks that you have, physical products, maybe it's a t-shirt, hoodie, whatever, but also set an investment perk. Maybe you change the valuation cap. If you invest in the first $100,000 or $500,000, you're investing at an $8 million valuation cap. And if you invest after that, you're gonna invest at a $10 million valuation cap. There's a lot of different things that you can do on the financing side to make it more compelling for people to invest up front. The more momentum you have up front, the easier it is to invest. No one wants to be the last person or the first person to invest. If you have 500 investors already, it's a lot easier to get 501 investors. If you only have 1 investor, it's really hard to get 2 investors, let alone your first investor. That's why it's really important to have your pre-committed investors up front. I definitely recommend leveraging your existing customers, your friends. That ties into getting all of the groundwork done before you even launch. And then ask for investment directly. It's great to send email. Email is probably the highest converting channel. If you have a big email list, great. Send out information, communicate regularly, and build a funnel so that you can get people to your campaign site and eventually make that investment. But it doesn't hurt to email people directly, call people directly, people that you know personally, and ask them for that $5,000 investment, $1,000 investment. It's a lot easier to make that personal connection, and people are more comfortable handing over their, opening up their wallet and entering their credit card to invest $1,000 in an early stage company that may not return any money at all, but they know you personally and they want to support your vision. They want to see you impact the world. And that is the reason why they're going to invest in you, not because they're trying to make a financial return. So if you make a personal effort and you reach out to people, that'll make you much more successful. Again, if you're interested in raising money online through equity crowdfunding and you want to do it through Wefunder, it's a great platform. As you can see, the results speak for itself. Check out the link in the description. Saves you 10% off all the fees, which can save you thousands of dollars if you're going to raise money that way, in addition to the making potentially hundreds of thousands, $1 million online, and you'll get zero upfront fee. Check out that link in the description. Also, check out the video I did if you're watching the video to now. Thank you. Definitely let me know in the comments what you guys are working on. As always, take care, stay safe, and keep hustling.